Hello and welcome guys, and welcome to the second part of the audit marathon. And in this part we are going to start second chapter of our syllabus, and second chapter, as you can see, holds consistently of 5 to 6 marks in the last 3 examination. And before that, this chapter has been coming for even more than 5 to 6 marks. It has been coming for 8 marks. And yes, it is an important chapter because it deals with audit engagement, audit program, audit working papers, audit notebook, audit evidence, and audit report. So in a nutshell, this chapter includes all the documentation which is required to make any which are required to be made in any audit since its inception. So this is the starting point of an audit and this is the ending point of an audit. So all the documentation which is required to be prepared since the beginning of the audit to the end of the audit is noted in this particular chapter. And mind you guys, documentation is one of the most important areas of audit, because if you are not able to prove before the authorities the kind of audit which you've done and the substantial evidence which you've gathered, you have to demonstrate them by way of your evidences, which are documentary proofs only. So documentation is one of the most important elements of any audit. So let's start our chapter with the first documentation which takes place in any audit, that is audit engagement letter. So guys, what is an audit engagement letter? Audit engagement letter is a written agreement between the auditor and the auditee, in which all the terms and conditions of the audit are recorded. So whatever is being agreed between the auditor and the company, all those things are to be recorded in the engagement letter. For example, the scope of audit. What is auditor supposed to do? What is the fees of audit? I mean, what auditor will get after the audit is done? All these things are particularly noted in the audit engagement letter, so that tomorrow the client should not be able to contradict the auditor's view of demanding a particular fees. The client should not be in a position to say that auditor should have done this thing as well. So to give you an example, auditor is not supposed to prepare the financial accounts or cost accounts of a particular company. Now, if this particular aspect is clearly written in the engagement letter, then tomorrow client will not be able to say that you were supposed to prepare the cost record as well. Please do the cost recording and then you should do cost audit, or same goes for financial audit as well. So this written agreement will contain all the minute details, all the responsibilities which an auditor would entail, and all the things which auditor will assume, all the responsibilities which auditor will assume during the course of audit, including his fees, his restrictions, his area of work. If any scope is limited, so that scope will also be written in the engagement letter. So all these things are made in writing by the auditor and the auditee, so that no dispute arises at a later stage. So let's see what is the definition of engagement letter. The engagement letter is the auditor's contract or agreement with the client or the entity which is being audited. So whatever entity is being audited, for example, if you are doing audit of say ABC Limited, then your agreement with ABC Limited will be defined under the engagement letter. And the engagement letter is the starting point and oftentimes the ending point for the relationship. Yes, so engagement letter is the starting point because it enumerates when the audit will start, when the engagement will start, when will the client give all the details to the auditor, when will auditor start its work, when will auditor end its work, what is the audit report timeline. All these things will be written by the auditor. So starting point of an audit is definitely audit engagement letter. And the ending point of the audit, which means what fees will auditor charge, when will auditor issue its audit report, and whom will auditor issue its audit report. All these things are also written in the engagement letter. So the ending point, the last point of the audit, is also written in audit engagement letter. Audit report is often the last aspect of any audit. And audit report, what format of audit report will be there, when will audit report will be issued, to whom will the audit report be issued, all these things are also written in engagement letter. So the starting point and the end point of any audit is audit engagement letter. Audit engagement letter is given by the auditor to the company. So guys, both auditor and the auditee signs the audit engagement letter. But yes, the audit engagement letter is prepared by the auditor and it is given by the auditor to the client, who signs it and sends it back to the auditor, explaining the scope of work, duties and responsibility of auditor and that of management of the company. So as I was mentioning, that this engagement letter will clearly communicate or clearly mention that the responsibility of preparing the financial statements will be of the management of the company and not the auditor. This will be clearly written in the engagement letter. So yes, many things are obvious, but in legal world, even the obvious is to be stated. It has to be in writing. It has to be in black and white. Otherwise, no one will follow it. So we have to state the obvious and the not so obvious things in the engagement letter. So what are the constituents of engagement letter? What all things will be covered under the engagement letter? First of all, it will be objectives and scope of engagement. So what is the scope of engagement, which means what type of audit is to be conducted for the client, whether it is GST audit, whether it is income tax audit, whether it is financial audit, whether it is cost audit, what kind of audit is to be done and under what law is this audit to be done. So I have explained you in first marathon part as well that audit can be done under various laws like Income Tax Act, like Companies Act, like GST Act. So which law are you referring to while you are doing this particular audit? This is to be stated in point number 1, which is objective and scope of engagement. What is the objective of engagement and what is the scope? What all accounts are to be seen? This is known as scope. So whether cost accounts are to be seen or financial accounts are to be seen or tax related books of accounts are to be seen or GST books are to be seen. What is to be seen? This is clearly mentioned in the engagement letter. So that tomorrow the client should not come back to the auditor and say, Mr. Auditor, you have done the cost audit of our company. You have audited the cost records. I wanted you to audit the GST records as well. Why didn't you audit GST records? Then auditor should have a shield against the client to prove that the agreement was only done for cost records and not GST records, and hence only cost records have been audited by the auditor. So this is the first point of engagement letter, which is objective and scope of engagement. Second is auditor's responsibility. What is the responsibility of the auditor? Guys, the responsibility of the auditor is to depict a true and fair view, to create an opinion and express an opinion on truthfulness and fairness of the accounts. The responsibility of any errors and frauds in the accounts is the secondary objective. To find out those errors and frauds is the secondary objective of the auditor. The first objective is just to express an opinion whether the accounts are prepared fully as per the required law or not. That is the primary objective and responsibility of the auditor. So auditor will clearly state that my responsibility is to express an opinion. I will neither prepare books of accounts nor will be responsible for digging out any fraud kind of a situation in the company. But yes, if during course of audit I am faced with some fraud, then I will intimate it to the client's management. Do you remember, guys, in part 1 we had studied that investigation and audit are two different things. So fraud is to be investigated. So auditor's responsibility is not to investigate upon fraud. If any fraud kind of a thing is found out by the auditor, then he should simply express it or disclose it to the management. That's it. There is no other responsibility of the auditor with respect to fraud. So this is the second point, second constituent of engagement letter, that the auditor's responsibility is stated in the engagement letter. What is the work which auditor needs to do and for what things will the auditor be liable. Then third point is management's responsibility. So the engagement letter should also contain management's responsibility, which means that whatever things management needs to do. So for example, thing number 1, very obvious, that management needs to prepare the financial statements. So the first responsibility of the management is to prepare the financial statements. This responsibility is clearly stated in the engagement letter. Second responsibility is to have checks and balances within the system so that errors and mistakes are avoided. These are known as internal controls. So in the subsequent chapters, we will study this concept of internal controls, which is employed by the management. So management should clearly take the responsibility of the operational aspect of its organization. So it should be clearly mentioned in the engagement letter that the management should take care of the internal operations and internal controls of any of its organization, and the auditor's responsibility is just to check whether those controls are working fine and whether the systems are working to the appropriate standard or not. But to record the books, to record transactions truthfully in the financial statements, to maintain a good ERP system, to have a strong checks and balances over the financial statements, the responsibility lies only and only with the management. Auditor's responsibility is just to express an opinion. So we will write clearly about management's responsibility in point number 3. Point number 4, existence of inherent limitations of audit. So guys, as we have studied that auditor has a very limited tenure, very limited time to complete the audit, which means auditor might have just say a few days to complete audit. In such a short span of time, it is not possible for the auditor to review or to check 100% of the transactions. In such a case, the auditor should take help of techniques like sampling. He should sample test check certain transactions to ascertain whether the entire gamut of transactions or the entire family of transactions is fine or not. 1-2 transactions can be tested. This is known as test check, which is also known as sampling. Now sampling comes with its own problems. Problem is that sampling in itself has a limitation that the samples which are not picked, they run a big risk of being erroneous or being mistaken. So the auditor is running a risk of expressing an inappropriate opinion. Why? Because he is doing audit on the basis of sampling, and it is not possible for any auditor to completely check 100% of the transactions because transactions run into lakhs and lakhs of number. So the engagement letter should express this limitation of audit, that audit is always conducted on test check basis, and due to its nature of sampling, the auditor is facing a risk, a consistent risk of being wrong in its opinion. So this is the inherent limitation of audit which should be expressed in the engagement letter. Management representation letter. Now this is a very important aspect of any audit, guys. Representation letter is to be taken from the management. So at this stage, at engagement stage, management should agree that it will issue a representation letter, and when audit finishes, the management should issue a management representation letter which should state that all the financial statements, all the procedures which are to be followed, like inventory counting, fixed assets counting, all these things are done by the management and they are personally supervised by the management properly. Now auditor cannot go and verify each and every transactions, each and every fixed asset, each and every inventory. Auditor cannot do 100% check. So to a very large extent, auditor has to rely on the internal controls which are established by the management. So in the MRL, which is the management representation letter, the auditor should take in writing from the management that all the transactions are being supervised and managed by the management well, and he should take it in writing that certain transactions like physical verification of fixed assets, which is not personally attended by the auditor, those kind of things are being done by the management senior staff. So this is known as MRL, and in the engagement letter, the management should agree that it will give MRL to the auditor at the end of audit. Next point is restrictions and limitations of auditor's liability. Now this is a very important point, and this point states that what is the financial liability which can be imposed on the auditor if anything goes wrong. So for example, if auditor's report does not mention about some loans which are faulty, some debtors, some loans which are given by the company which are shown as assets, they are faulty, they are irrecoverable, and the auditor misses upon this point, and management also misses upon this point, then what should be the auditor's liability? As in, would auditor be liable to repay that amount of debt to the company? Can auditor be subject to monetary penalties if something goes wrong? That is known as the restrictions and limitations of auditor's liability. Guys, I have seen in my practical experience that auditors are always restricting their monetary liability to the extent of fees which is received by them from the management, and they do not accept any monetary liability over and above the fees which is received. So fees is the restriction which management has, limitation on auditors liability which auditors generally accept in India. And guys, sometimes I've seen in US the trend is that the auditor accepts a restriction or a limitation of liability to the extent of 3 times of audit. So if audit fees is 1 lakh rupees, auditor is okay to undertake a liability on behalf of the client to the extent of 3 lakhs if anything goes wrong because of the audit report. So that is the clause which is known as restriction and limitations of auditor's liability. The next point is basis of computation of audit fees and billing arrangement. This is the most important point. Number 1, what should be the fees? Audit fees, what should be the amount of the audit fees? And billing arrangement means what is the timeline for payment of fees? So when should fees be payable to the auditor? Whether the entire fees will be paid at the end of the audit to the auditor, or the fees will be paid in parts, like half of the fees can be paid at the engagement letter signing date, and balance half can be paid at the time of auditor's report when it is issued. So it depends on the mutual agreement between auditor and the auditee when the fees is to be payable to the auditor. Then form of report and other communication of engagement. What should be the audit report? What kind of format should it follow? How should it look like? Guys, generally audit report format is prescribed by the law itself, according to which audit is being governed. Like Income Tax Act has a specific format, 3CA and 3CB for the audit. Cost audit has a specific format which is form CRA 3 for cost audit. Then similarly, financial accounts audit, statutory audit has a specific format. However, there are certain audits which are voluntary audit, like internal audit. Internal audit does not have any prescribed format. And management audit does not have any prescribed format. So especially in those cases, the management and the auditor agree upon the format of the report, what kind of report will be issued. So this is the this is another aspect which is covered by the engagement letter. Then validity of the report. What is the validity of the report? Can report be presented to the statutory authorities? Can the report be, auditor's report be issued or given to governmental authorities? Is the auditor's report valid to be produced for loan purposes, etc., etc.? So any restriction if auditor is wanting to place on the auditor's report with respect to its validity, then that should be written in the engagement letter. So for example, the auditor's report does not guarantee a safe future of the company. That future is very good, very bright. This is not a guarantee which is given by the auditor's report. So this should be mentioned in the validity section, that this report is valid only to the extent of financial accounts which are mentioned in the audit report. The need for use of services of internal auditors and other experts. So if during the course of the audit, the statutory auditor or the cost auditor needs to use the expertise of an external expert. Like auditor is not a valuation expert, so valuation of the fixed assets should be done by a valuer. Similarly, auditor is not expert in knowing what is the work in progress stage of work in progress of inventory while calculating the value of inventory. So in that case also, the auditor needs a specialized person who can be useful to the auditor. So all these things are to be done by external experts, and wherever external experts are required, the engagement letter should contain specific need and specific clauses which discloses that what kind of specialists are required at what stages of the audit. I'll give you another example, guys. Actuarial valuation is required for provisioning of gratuity and leave encashment, and the actuarial valuation are done by actuaries and not by accountants or the auditors. So he's also an expert. So that should also contain a mention for the actuary in the engagement letter. So depending upon what kind of experts are required, we need to mention name of the experts which are required during course of audit in the engagement letter, so that client is aware of the experts and he makes necessary arrangement for the experts to come. Then limits on submission of report to other authorities. If the auditor wants to limit the free circulation of the auditor's report, then auditor can do it via this clause. So sometimes some reports are very confidential. For example, cost audit report is a report which is very, very confidential because it contains the secret of the company, like what kind of raw material is being used, what proportion of raw material to raw material is being mixed to produce a particular product. These are very sensitive information. So the cost audit report is not to be floated freely amongst anyone and everyone. So if an auditor needs to put some limit on submission of audit reports to authorities, then auditors can do so by this clause. Auditor can specifically state that we are issuing this report, but you should not disclose this report to so and so person or to any bank or to any other person, third party. Usually this restriction cannot be made for governmental organization, because if governmental organization wants any part of audit report, then that cannot be denied by the company. So usually it is not for government parties, but it is for some private parties like banks, or like these reports cannot be used for taking loans. Sometimes auditor can put a restriction on taking loans, etc. So we should be careful in drafting this clause. An auditor can restrict its liabilities using this clause, which states that limits on submission of report to other authorities. On the next page, a specimen of engagement letter is given for all of you, and considering the time which is left for the examination, you can easily skip the specimen copy of the engagement letter. This is just for your knowledge, guys, and in exam there might not be a question which will ask you to create or draft an engagement letter, so you can easily skip this engagement letter. So I'm also skipping this engagement letter. You can read it after your examination, but currently you can skip this entire engagement letter. And I am coming on to the next topic of benefits of having an engagement letter. So what are the reasons because of which engagement letter is signed between the client and the auditor? The reasons are very, very clear. There is no ambiguity of terms, what has to be done by whom, whose responsibility is there, who is liable to what an extent, what kind of work is to be done, which laws are to be followed. All these things are written in black and white inside the engagement letter. So the very first benefit of having an engagement letter is to avoid confusion. There is no confusion, there is clarity of work, there is no ambiguity in the objective and scope of an audit. So the first objective, the first benefit of having an engagement letter is to avoid confusion. Second one is to define the responsibility of the auditor and the management, who is responsible for what, who will do what, and the liability will be restricted to what extent. All these things are defined in the engagement letter. So the responsibilities of an auditor is clearly demarcated in the engagement letter. Then third is it protects the interest of the auditor against the allegations of professional misconduct. Guys, this is the biggest threat which any auditor can have, which is allegation of not performing his duties well, because the Institute of Chartered Accountants of India, Institute of Cost Accountants of India are the regulatory body to regulate the audits of both kinds, statutory audit and cost audit. So tomorrow, if a cost accountant is found to be negligent of his professional due diligence, professional care and his professional duty, then he might be reprimanded, or he might be prosecuted, or he might be devoid of his degree, CMA degree and CA degree. So if an auditor wants to prove that yes, the kind of work which he's done under the engagement letter. So I'll give you a simple example, which is a real life example which happened in one of the companies. So the management of the company asked the auditor to not to audit certain type of expenses. Now those expenses were forming a key part of the financial statements, which is the profit and loss account. Still, the management asked the auditor specifically not to perform any audit procedures on those particular expenses. The auditors wrote this fact in the engagement letter, that the management has denied me to perform these activities and perform these procedures, and the audit was carried on. After 5 years, 4 years or 5 years, there was a major fraud which was detected in those expenses, and auditor was asked as to why didn't he perform any audit procedures on those expenses. So he had a simple explanation that the management had restricted me to do so, and the engagement letter was also evident of that fact. So the court held that the auditor was not negligent in his duties. So just because auditor took care of writing the fact that he was restricted in his scope of work, he was not reprimanded, he was not convicted of any professional misconduct. So if a auditor wants to protect himself from any kind of allegations in future, then he has to clearly write his scope and objectives and his entire scheme of doing the audit in the engagement letter. So these are the three benefits of having an engagement letter. It avoids confusion, it defines responsibility, and it protects interest of the auditor. Next topic, which is a very important topic, is audit program. Guys, audit program is nothing but planning. So whenever you go on a vacation, or you go to meet your relative in another city, or you want to visit some far-fetched place, then you make a plan. Plan as in you decide how will you get there, what kind of conveyance will you use. Will you use your bus, or will you use your car, or will you use the train which is existent in your city? What will you do? So planning is essential for any and every element of life and work. Similarly, planning is also essential before an audit, because if there is no planning, then that activity will be done in a chaotic manner, and not in a systematic manner. It will all be haphazard. So to avoid this chaos, we need to plan even audit procedures, who will perform the audit, how many staff is required, how many days are required, what kind of financial statements are there which are to be audited, which account head is to be audited and which is not to be audited. So all these things require careful study and planning before this audit commences, because if audit commences without planning, then no one will be able to understand their responsibilities, and everything will be in a chaos. So audit program is that document which will ask the auditor to write its plan of auditing before the audit starts. So audit program is nothing but an audit plan which is written on a piece of paper. It is a very strong evidence of documentation of what the auditor proposes to do and what the auditor actually does in an audit situation. So let's read the definition of audit program. An audit program is a detailed plan of auditing work to be performed, what work is to be performed, then what procedures are to be followed for verification of each item, estimated time required, how much time is required, estimated resources required. Resources means how many people are required, how many laptops are required, how many trainees are required. So these three things are there in an audit program. Audit work, what audit work is to be done, how is it to be done, that is the procedure of audit work, how much time will it take, and how many people will it take. These four things constitute an audit program. It is the description or memorandum of work to be done during an audit. Audit program serves as a guide in arranging, distributing audit work as well as checking against the possibility of omissions. So audit program not only is helpful in planning your work and systematic doing your work, it also helps you to avoid any omissions. So if you have written all the audit procedures in a document, then you will be reminded of those audit procedures again and again and again. So the chances of missing out on anything reduces if you have a detailed audit plan. So possibility of omissions are also omitted due to the audit program. Now I've given a sample of an audit program of say salaries and wages, an account head which is salaries and wages. What will it have? It will list down who will prepare this, who will audit this particular head, who will review this head, what head is there, which year is there. Then what are the procedures which are to be followed, like verify the payroll is reviewed, authorized by the senior person, you have to verify it. Then work paper reference, you have to mention the number of work paper, the work paper reference which proves this point which you have verified. Then reviewed by and due date, here you need to put your signatures and you have to put the date on which you have performed this audit procedure. Coming on to the next one, confirm computation of wages, computation of wages to be computed. Then again working paper references to be given. Then you have to sign whatever whosoever has done this audit procedure has to sign over here. Similarly, other procedures are carried out in an audit program. So audit program is a list of procedures, list of the aspects which are to be seen in an audit, and it is very important to have this kind of an audit program before an audit starts, because proper planning will ensure that audit goes in a smooth manner. Then what kind of audit programs are there? There are two kind of audit programs: common audit programs, which are common to all types of audit. Like there are certain basic things which are necessary in every audit, like secretarial books are to be seen in every audit. So audit program will definitely have secretarial books for all the companies, because secretarial books are required to be maintained by all the companies. Then there are some special audit program. These are audit programs which are specific to a particular audit or entity. Now these audit programs are not general audit programs, these are specific audit programs, and they are to be applied only for certain type of entities. Like partnership firm would contain step for checking for profit sharing ratio. Now this step will not be there in a company. So the program which asks you to check the partnership firm's profit sharing ratio, that audit program is a specific audit program. And what is a common audit program? An audit program like checking of secretarial books of accounts is like common audit program. It is audit program for all the companies which are registered under Companies Act 2013. Now what are the advantages of audit program? Guys, you tell me, what are the advantages of planning? If you plan your studies, if you plan your vacation, if you plan anything in your life, what is the benefit of having a plan? Simple. It makes your works easier, it makes your work systematic, it ensures timely completion of work, it ensures that you do not miss out on anything, it ensures that your responsibilities are fully people are aware about their responsibilities, and the work is done in a proper manner, in a timely manner. These are the benefits of a plan. Similarly, audit programs benefit are also similar. So what are the advantages? It is a checklist for audit procedures. So to ensure that nothing remains, nothing is left out in a particular audit program will have a checklist, and that checklist serves as a proof that nothing has been left out in an audit. Audit work can be properly allocated. So you can know what work is to be done by which person. So allocation of work is done through audit program. Then extent of work, what is the extent of work which is already done? If audit program is prepared and it is signed on a regular basis, then whosoever looks at the audit can know what extent of work is already done in a particular audit. So it also serves as a supervisory benefit, because anyone who's reviewing the audit can come to know which procedures have already been done and which procedures are pending. Then it is good to fix individual responsibilities, because if some work is not done, then you know who had to do that work and you know whom to blame. So to fix individual's responsibility, to fix who has not done his work properly, you use the audit program. Then uniformity of work will be done in a uniform manner. So things which are common to every audit, that will be done in a uniform manner, and there'll be no leftover, there'll be no mistake, or there'll be no dynamics in a particular situation which is a usual situation. So uniformity of work is a major advantage of audit program. Then it also serves as a basis for planning program of the following year. So once your audit is over for the current year, same audit program can be used for preparing the audit program for the next year as well, whenever audit comes for the next year, because largely the account heads will be same, the business of the organization will be same. So same audit program can be used for next year as well. Then it is also used as an evidence by the auditor to prove that he has done all the steps properly during an audit, and in future if someone puts an allegation on the auditor that he has not done anything properly, auditor can simply show his audit program and he can prove that he has done all the steps of the audit properly, and he has performed the audit with due diligence and absolute care. Then the last advantage is that team member and delegation of responsibility to them. Again, it is similar to the point which we had studied earlier, which is individual responsibilities. This point is similar to this point, that individual members are given the responsibility of a particular task, and they are also delegated with the responsibility of completing it. So if that work doesn't get completed, then the direct liability is to be fixed to that particular person, which means that it is easier to fix responsibility in case of audit program, if audit program is properly constructed. Now there are certain disadvantages of audit program as well. There are some problems with creating audit program as well. What are those problems? Those problems are auditor's task becomes mechanical, and auditor may lose interest and initiative. So guys, if you are instructed to do a particular thing in a particular manner, then sometimes you don't feel like inventing something new. You don't feel like having any creativity or innovativeness. You don't apply your mind. You just follow the checklist and just do things mechanically. So if a checklist is given to you, then there's a greater possibility that the auditor does everything mechanically, and he does not do something which requires application of brain, and he would just follow the steps which are written in the checklist. In case there is no checklist, then the auditor has to apply his mind to do audit, and in that situation the benefit will be that there might be certain instances where something new comes out of the picture which is not there in audit program. So first disadvantage is that audit becomes mechanical, which means it becomes monotonous and boring for the auditor. So as a routine auditor does audit, and not as a proper professional due diligence is not sometimes followed by the auditor. Second is that for small organizations, this audit program does not seems to be a good idea, because small organizations are so small that you hardly need any planning for completing the audit. So in case of small firms, small organizations, audit program is just a waste of time and waste of effort. You can just go over there and do the audit rather than preparing a audit program. Then audit program helps in fixing responsibilities, but inefficient staff may defend themselves by stating that matter was not contained in the audit program. Now assume a situation where an obvious thing has not been stated in the audit program. In that situation, the staff which is inefficient, the staff which is not so indulged in work, that staff will take that mistake of not having something obvious in the audit program as an excuse of not doing that thing. So if it is an obvious thing that it had to be done, then whether it is in the audit program or not, it should have been done. If it is not there in the audit program, then the audit staff will take it as an excuse of not performing that particular activity. So this is a drawback of an audit program. Then rigid audit programs cannot be laid out for each type of businesses. So every business requires a different audit program. That is also one of the shortcomings of the audit programs. Now we are on to the audit working papers, guys, and as I have already told you in the beginning of the chapter, that this entire chapter deals with the documentation bit of audit, and which is one of the most important aspect of any audit, documentation. So we have discussed about engagement letter, we have discussed about audit program. Engagement letter is the first step in audit. Audit program is the second step of audit, which is planning. Now the third step of audit is actual execution. And during execution, we need to prepare audit working papers. These working papers should disclose the methods which are followed by us, the things which are followed by us to perform an audit. So these working papers are very, very important from a evidence standpoint. Evidence are created through these audit working papers. So audit working papers are record of planning and execution of an audit engagement. Auditors retain a set of working paper for each audit engagement for each year. Audit working papers should be sufficiently detailed to enable other auditor who is not familiar with the client to obtain an overall understanding of the engagement. So audit working papers should be made in a fashion that a person who is totally unaware about this particular audit is able to gauge the procedures which you have done to perform audit of this particular client. So these are the qualities of an audit working paper, and I have already told you that these audit working papers serves as a shield for the auditor if in future he is alleged of gross negligence or misconduct, anything of that sort. If he is alleged, then these working papers prove to be his shield. He can protect himself from any such allegation. Purpose of audit working papers. What are the purpose of audit working papers? Planning and performance of an audit. So you plan and perform audit. Of course, planning is done through audit programs, which in short are known as APs, and performance of audit are done by audit working papers, which are known as AWP. Supervision and review of audit work is done through audit working papers and then serves as an evidence of audit work performed by the auditor. So whatever work auditor does, the audit working paper are the proof or are the evidence of whatever audit has been done by the auditor. And audit working papers are discussed in Standard of Auditing 230 in great detail, and all the working papers which are to be maintained by the auditor are discussed in that Standard of Auditing. And let me tell you one more interesting fact, that audit working papers are property of the auditor, and the company cannot force the auditor to give the audit working papers to the company. This is the law, this is the directive which has been issued by the Institute of Chartered Accountants of India. Now, factors affecting type of audit working papers. So what kind of audit working papers are created? This is governed by the following factors. What are those factors? The form and content of working papers vary from audits to audits, and they are affected by the following matters. Number one, nature of engagement. What kind of engagement have you entered into? Is it a income tax engagement? Is it a cost audit engagement? Is it a management audit engagement? So every engagement will have a different type of audit working paper. Form of audit report. What kind of audit report is there? Is it a abridged audit report or is it a detailed audit report? So if it is a detailed audit report, then working paper will also be detailed. If it is abridged audit report, then the working papers will also be abridged. So depending upon what kind of audit report has to be issued, your working papers will change accordingly. Nature and complexity of client's business. If the client's business is complex, then the working papers will also be complex, and vice versa. Then client's records, internal controls, and supervision of work performed by the assistants. These are other factors which will determine what kind of audit documentation will you have. Because so I'll explain you point number E, which is really important. So if an auditor is relying on the internal controls which are imposed by the management, then the audit working papers will be less rigorous. And if the auditor does not believe in the internal controls which are established by the management, then auditor will perform rigorous audit procedures. So the working papers will be much more in that case. So these are the factors which will determine what kind of working papers will you have. Then types of working files. So you must have seen files, the cardboard files or the plastic files which are used in offices. Yes, this topic relates to those files only, but those files which are maintained by the auditor. So auditor has to obviously if there are documents, then those documents are to be retained somewhere, are to be stored somewhere. And the best place to store the documents are files. We create files for the documents, and the files are then stored in the cabinets. So now audit files are of two types. There are two separate types of files which are used by any auditor. First is the permanent audit file, second is the current audit file. So guys, permanent audit file is the audit file which contains the documents which are used by the auditor year on year every year. So if an auditor is doing audit for a client for 3 years, then such documents which are used by him for all the 3 years are known as permanent documents. I'll give you an example: memorandum of association, articles of association. These things are required by auditor every year because he might refer to them for knowing the object clause or the activity clause or the profit sharing clause or the rights clause. He would require these documents every year for all the 3 years. So these documents will be placed in a file called permanent audit file, and this audit file will be used by the auditor for all the 3 years. Now there will be another audit file which is temporary audit file, current audit file, which will contain the documents for that particular year only, which means if the audit is being conducted for year 2019-20, then this current file will have all the documents which are related to year 2019-20. This file will not have the documents which will be relevant for the year 2021. This will only have the documents which are relevant for 1920. For example, accounts, ledger accounts. So guys, ledger accounts are required for only 1 year, because you prepare a ledger account for 1 year. Then for the next year, there will be a new ledger account. So the old ledger account will not be used next year. So ledger account is an example of a document which will be used only in the current year, and hence it will be kept in current audit file. So auditor need not carry the current audit file in the subsequent years. He can just store the current audit file in his office, and he just have to carry permanent audit file for each year of audit where he is appointed as the auditor. So this was the broad difference between permanent audit file and current audit file. Now let us go through the differences in detail. It relates to more than one accounting period. It relates to only one accounting period. It contains document related to organization structure. It contains document related to current year, like engagement letter, like board meeting, AGM meeting. Guys, all these documents are prepared afresh for each year under audit. They are not prepared once and used for each year. No, they are prepared for each year separately. And these documents are prepared for once and they are used in audit for each year. Then deficiencies in internal control are to be kept in permanent audit file, so that auditors of the future years are also able to understand what are the problems in internal control systems. Then assumption in management letter is an element of putting it in current audit file. Significant ratios and trends are to be put in permanent audit file, and transactions for the year are to be put in current audit file. Significant accounting policies, permanent audit file. Audit program for the current year, only current file. Significant audit observations of prior years. So if there are major defaults which are found in the financial statements or cost statements of a company, then those defects or defaults are to be highlighted to the future auditors as well, so that they can lay higher emphasis on those areas. So to lay higher emphasis on those areas, they should be aware about those areas, and those areas are recorded in the permanent audit file. Then in the current audit file, the significant aspect of audit of that particular year which will not affect the future years are kept. So this is the difference between permanent audit file and current audit file. Guys, an important topic. It recurs in the examination a lot. So next topic is ownership or title to audit working papers, and I've already told you that auditor is the owner of the working papers, and it is auditor's prerogative if he wants to disclose or give the audit papers to the client or not. Institute of Chartered Accountants of India have released an advisory where they are saying that it is entirely auditors' discretion on whether they want to share their audit working papers with the client or not. So you cannot force an auditor to give his working papers. A client cannot force an auditor. So that is the law. Working papers are property of the auditors, and the portions or extract of which can be had at his discretion. The important words are at his discretion. Only if the auditor is willing to give out the working papers, then only can it give. However, if required by some legislation, if law is asking the auditor to give the working papers, then the auditor has to make working papers available to the regulatory authority and not the client. Again, the force is given by legislation, and legislation requires the auditor to give the working papers to the regulatory authority. I'll give you an example. So you must have studied assessment procedures in your income tax. When the assessing officer or the CIT appeals or the ITAT assesses your case and hears you out and decides whether you have paid the taxes correctly or not. Guys, in these proceedings, sometimes the assessing officers call upon certain documents from the auditors so that the authenticity of the financial statements and the details of the financial statements can be vetted or verified. In that case, the auditor has to and must give the audit working papers to the statutory authority, which is income tax authority. In this case, auditor cannot deny giving the financial statements or the documentation which is required by the statutory authority. However, yes, if a company requires an auditor to give the audit working papers to them, then it is under auditor's discretion whether they want to give or not. These working papers should be kept in safe custody and in confidential manner for 7 years as prescribed by the Institute of Chartered Accountants of India as per SQC 1. Guys, the next topic is an important one, which is the audit notebook. Now, during day-to-day working of an auditor and day-to-day operations of audit, sometimes a lot of things are communicated by the management orally and not in written. Management is very smart. What would management do? The things which are little dicey, the things which even management is not sure of, management would not give all these things in writing. They would give these things in oral. They would tell you that yes, this debtor is going to be bad, so we can create a provision for this bad debtor. Now, it is auditor's responsibility to note down all these things in writing so that A, he does not forget the facts, and B, if tomorrow management refuses to accept the fact which they had stated, then the auditor can show the management his recording and he can prove that management had said these words to the auditor. So basically, to gather proof, to gather evidence, the auditor always carries a notebook, a normal notebook, a normal register, just like you prepare a register for your costing, for your income tax, a separate register for every subject. So that whatever teacher is teaching in the class, you quickly note down everything in the class. So those practices are also used in audit. Whatever is being said by the client which is not given in writing, all those things are to be written in the audit notebook so that tomorrow audit notebook can be used as an evidence or can be referred to as a information provider. So an audit notebook is a bound book in which large variety of matters observed during the course of audit are recorded. Audit notebook is a permanent record of auditor and it is a separate audit notebook. Audit notebook should be maintained clearly, completely and systematically. An audit notebook may be used as an evidence to defend the auditor against any charge against them. So again, same point guys, to defend against any charge, to act as a shield for the auditor, audit notebook is also one of the most important documentations which are there in audit. Then what are the contents of audit notebook? Name of the business is written, organization structure is written, MOA, AOA important provisions are written, communication with previous auditor. If previous auditor has given some communication to the current auditor, if he has given some hints on how the company is performing, what are the difficult areas, why did the earlier auditor leave, any such verbal communication which is done by the earlier auditor, they are to be recorded in audit notebook. Management representations and instructions, whichever management is giving verbally, all those things are to be properly recorded in the audit notebook. List of books and accounts maintained by the enterprise, accounting methods, internal control system followed, applicable laws, key managerial personnel. So who are the people who are responsible for taking key decisions with respect to finance, with respect to marketing, with respect to advertising? All those persons' name should be written in the audit notebook so that you can refer to it at a later stage. Errors and fraud discovered are to be recorded in audit notebook. Matters relating to explanations and clarifications, and here we specifically deal with the explanations which are given verbally by the management and not in writing by the management. Those are to be recorded in the audit notebook. Special point that need attention in the auditor's report. If any special point is to be discussed with the management in the auditor's report, then that point is also written in the audit notebook. Now comes a very important point, a very important aspect of your syllabus, which is audit risk. You can put a star, you can write very important, because in examination this topic is recurring a lot of times. Now what do you mean by audit risk? Now before discussing audit risk, I would like you to tell me, what do you mean by risk? What is a risk? So in simple word, risk means probability of not getting what you want. Whatever is your objective, probability of not achieving that objective is known as a risk. So now tell me, what is the objective of doing audit? It is to express a true and fair opinion on the financial statements of the company. This is the objective of audit, to express a true and fair opinion, that we auditor will express the validity of the accounts, the accuracy of the accounts. We will vouch for the accuracy of the accounts. That process of verification should be unbiased and should prove to be truthful and fairful. Okay, so truth and true and fair view is to be expressed by an auditor. Now what is the risk? That auditor does not express this true and fair view. That is known as audit risk. So probability of not achieving what you wanted to achieve, whatever was your goal, is known as audit risk. And in this audit risk, the most important audit risk is that the auditor expresses an inappropriate opinion. Where the books of accounts are not showing true and fair view, there if auditor certifies that books of accounts are showing true and fair view, then that is known as the misstatement which auditor has done, and there is a risk which is associated to any statement which is produced by the auditor, and that risk is known as audit risk. Now let's read the definition of audit risk. It is the risk of material misstatement. Material means important or major, and misstatement means mistake. It simply means if you have done something erroneously, if you have mistaken in doing something, of an item that is included in the audited financial statements of an entity. So audit risk is the risk that some important or major mistakes are left out, which are not pointed by the auditor in the financial statements. Audit risk is always greater than 0, so there has to be some kind of audit risk which is always there. There's always some risk of material misstatement, and audit risk may emanate from either fraud or error. Fraud or error are also two areas from which audit risk arises, because if there's a fraud happening in the company and the auditor is not able to detect that fraud, then it is a major risky area for the client and for the auditor, because then the auditor will express an inappropriate opinion. Yes sir. Now what are the types of audit risk? Now there are 3 types of audit risk: inherent risk, control risk, detection risk. And if we multiply all 3 of them, then it gives us audit risk. So if I apply a formula to audit risk. Audit risk is equal to inherent risk multiplied by control risk multiplied by detection risk. So what are these three risks? We are going to now study. Number one, inherent risk. Now please understand what do you mean by inherent risk. Inherent risk means some risk which are already existing in an account statement, which will not be removed by audit procedures. Whatever audit procedures auditor can apply, he can apply, but those risks will remain in those account heads. The risk may be reduced to a certain extent by the procedures which are done by auditor, but majorly those risks never end. These are known as inherent risk. I'll give you an example. If there is a complex calculation of a particular expenditure, or there is a complex calculation of gratuity payment which is to be made, or leave encashment payment which is to be made, or provident fund payment which is to be made, if there is a complex calculation which is there, then there is an inherent shortcoming in that calculation, that it may be erroneous. If it is complex, so actuarial valuation is a very complex procedure. Even chartered accountants and auditors and cost auditors are not able to apprehend or comprehend what is written in the actuarial valuation report. So sometimes, due to complexity of an account head, there is an inherent risk of misstatement, which means mistake. Similarly, I'll give you another example. If now you are making a provision for bad and doubtful debts, now please remember that it is just a provision. There is a risk that you provide for an amount which is due to Mr. A as bad debt, but there is a possibility that after 2 years he pays back your entire money. So there is a risk in estimation. This is known as risk of estimation. Wherever you estimate, there is a risk that your estimation will go wrong. These are certain inherent risks which are existing in certain account heads, and this will always remain in an organization. And in an audit, an auditor cannot reduce the inherent risk to zero. It can just manage the inherent risk by doing his work efficiently. Let's read. It is the possibility of material misstatement in the either individually or when taken together with other misstatements, assuming that there was no internal controls. So either individually these misstatements are major, or when they are combined with other misstatement, they are major, they are above the materiality level, they are very, very important. So inherent risk is the possibility of mistake which can happen when there are no internal controls. If there are no internal controls, then this misstatement can happen. For example, complex calculation estimates again always run a risk of being materially misstated. Second is control risk. Now what is a control risk? Control risk, I've already told you, internal controls means the check and balances which are put in by the management to ensure that the financial statements do not have error and fraud. So even before auditor will come to the organization, the management will ensure that its financial statements are built up in a proper way. To give that insurance, management has to build certain balances and checks and balances, certain controls, like one transaction will be done by one person and checked by another person. This will ensure that the organization is recording all the events and transactions properly. So control risk is the risk that these control might fail, because again a human element is involved in these controls. So if I give you an example, to have a control in the amounts which are deposited to bank, Mr. A is the person who hands over the cash to the person who goes to the bank, and the person who goes to the bank takes the cash from Mr. A and deposits it in bank. This way the cash is deposited using two people, so chances of misstatement is very, very less in this case. However, there is a possibility that those two people join hands. If they join hands, then the control will lapse and a fraud or error can happen. So control risk is the risk that if the internal controls are not followed properly, or they are not strong enough to prevent a mistake or a fraud, then that risk is known as control risk. So control risk is the possibility of material misstatement in either individually or when taken together, which will not be prevented, detected, corrected on a timely manner by the accounting and internal control system. So these errors, and these mistakes will not be controlled by the internal control systems or the checks and balances which are put up by the management. For example, weak internal controls may lead to misstatement creeping into the financials. So if you have an organization which has weak internal controls, then naturally its errors and probability of fraud and probability of misstatement will increase. Then there is detection risk. Detection risk means that due to faulty procedures adopted by the auditor, the error and fraud is not actually detected. So this is the responsibility of the auditor to ensure that the audit procedures are proper. Now everyone is human, guys. You are a human being. I am a human being. Even auditor is a human being. When you will qualify and you will become a CMA, then of course you will be a human being first, and human being is prone to errors. So what is the probability that auditor performs an erroneous audit procedure which leads to a material misstatement in the financial statements? This risk is known as detection risk. Although this risk is very, very less because all the auditors are very careful in their auditing procedure, but still there is this risk, which is detection risk, which means that your audit procedures are not sufficient and good enough to detect the errors or frauds in the financial statements. These are the three types of risks, and it is an important topic, guys. Let's come on to the next aspect, which is surprise checks. Surprise checks are the checks which are employed by the auditor out of nowhere. He would not inform the management of these checks, and he would suddenly appear from nowhere and do some checking work. So for example, cash balance which is kept in the factory may be checked suddenly by the management may be checked suddenly by the auditor, and auditor can ensure that the balance which is appearing in the cash book versus balance which is appearing in the books of accounts, those two things should marry. So I'll again repeat, the cash which is present physically in the management's cupboard or the safe, that should match with the cash which is appearing in the books of accounts. Those two things should marry. So the auditor should suddenly appear some day and ask management to show their cash or show their inventory or show their fixed assets suddenly. This will induce a surprise element in the audit, and this will the auditor will be able to understand if there are any weaknesses in the internal control. Because if the auditor tells the management before coming, then management would ensure that all the systems are working properly. So surprise checks are one of the important tools which are used by the management to ensure that the management's work is doing properly. Then factors which are to be considered while doing surprise checks. Guys, these factors can be done by you very, very easily. These are simple factors which are to be seen while doing surprise checks, nothing complicated. Then we come on to audit evidence, and of course you have already in the last chapter we had discussed the three elements of the audit evidence. First behavior pattern of audit evidence was it should be relevant, then it should be reliable, it means you are able to rely on them, then it should be appropriate or sufficient. These are the three elements of audit evidence. Audit evidence should be relevant, it should be reliable, and it should be appropriate. These are the precise features which are there for audit evidence, and audit evidence are to be put in the file, guys, so that the file contains the evidence basis which an auditor has given his opinion. What is the need of audit evidence? So to prove that what kind of work has been done, and to prove that the management's assertion. Remember we had learned about assertions. Assertion means claims which a management personnel is doing over its financial statements. Like management would say that we have 100 crore worth of fixed assets. This is a claim or the assertion which is made by the management. As an auditor, I would want to find out the documents behind these claims so that I can comfortably comment whether the company has 100 crores of assets or not. So the first important part is that management makes assertion on various elements of financial statements. For example, the management may assert that it owns land and building worth 10 crore which are shown in the balance sheet. The auditor has to evaluate these assertions so that he would be able to express his opinion on the financial statements. Audit evidence provides auditor a reasonable assurance in respect of assertions made by the management. So whatever management is asserting means claiming. Evidence will prove the claims of the management. Now we'll tell you about what are the different assertions made by the management, what kind of claims are made by the management. Number one, existence. The management will say that my assets exist. They are not bogus assets. They are not just on paper assets. They actually exist. So existence is of assets and liabilities is a first claim that is made by the management. Second is rights and obligations. So management will first of all claim and then prove that I don't only have physical possession of the assets, I also have the legal title or the right on the assets. So the second thing which management should prove is rights and obligation on the assets and liabilities. First is existence, that the assets and liabilities do exist at the time of balance sheet. Second is their right and obligation is on the management, on the company. This is also to be proved. Occurrence, the transactions have actually happened. Occurrence is to be proved by the management by using substantiating evidence like invoices, like transporter bill, etc. So occurrence is an assertion made by the management. Valuation, whatever value is given in the financial statements of a particular thing, like bad debts, like provision for bad debts, like fixed assets. So in Ind AS regime, guys, fixed assets are no longer valued at historical cost. They are valued at fair value or the market value. So valuation is to be seen by the auditor whether the management assertion of true and correct value is right or wrong. Then measurement, what amount has been recorded in the books of accounts of every transaction, like revenue, like expenses. This is again an assertion which is made by the management. Management would always say my amount of expenses, my amount of revenue is perfect. But you as an auditor have to really cull out documents. You have to find out documents which prove that the claim of the management is correct. Then presentation and disclosure. Presentation is appropriate or not, disclosures are appropriate or not in the financial statements. So for example, if any asset is mortgaged for taking any loan, this has to be presented as a disclosure in the financial statements so that user of financial statement know that these assets have been pledged. So disclosures and presentation is one of the claims of the management. Management would say that my balance sheet is full of disclosures and is absolutely presented correctly, and the auditor should study whether the balance sheet is properly presented or not. So that is the thing which is known as the assertions of the management. Now types of evidence, guys, the evidence are of a lot of types. Some evidences are gathered within the factory premises or within the office of the client, and for other evidences the auditor might need to travel outside the organization, like going to bank for bank statements, going to debtors for confirmations. All these procedures are all these evidences are external evidences. So evidences broadly categorized on the basis of source. Then they are categorized as internal audit evidence and external audit evidence. Internal audit evidence are gathered from the management. Management will give internal audit evidence like vouchers, invoices, supporting evidence, and the evidence which are gathered by an independent third party. If a third party gives you some evidence about a transaction with the company, then that is known as external evidence, like confirmation from debtors, bank confirmation, etc. So guys, to confirm whether the bank has the bank account of the client has been appropriately reflected in the financials or not, for that thing bank confirmation is required. So an audit team member goes to the bank and gets sign of the manager to vet that the bank account of this particular company has so and so amount. So external evidence are these. So on the basis of nature, if you see that what is the nature of the audit evidence, it can be a oral evidence or a visual audit evidence. So for example, existence of a fixed assets is always verified by a visual evidence, which is the eyes of the auditor. Auditor has to see whether fixed assets are there in the factory to the amount which is disclosed in the financial statements or not. So on the basis of nature, oral or visual audit evidence and documentary evidence. Documentary means evidence which are there not in your eyes or memory or ears. These evidence are there on paper, that they are known as documentary evidence. Now on the basis of methods of obtaining evidence, what are the methods of obtaining evidence? Evidence obtained by the auditor himself, and evidence obtained by auditor through the management. So sometimes the auditor himself obtains the audit evidence. For example, auditor himself will go to the bank account and ask the bank to give a confirmation. This is procedure number 1. Procedure number 2 is that the auditor will ask the management to get a audit confirmation from the bank. The responsibility of getting audit confirmation is on the management of the company. So auditor can ask the management to get the confirmation from the bank. Now obviously, if management is involved in any transaction, then there might be a possibility that management, while bringing that confirmation on board, can tamper with the evidence. So the more relevant audit evidence is the audit evidence which is gathered by the auditor himself, and the less reliable audit evidence is the audit evidence which is gathered by the auditor through the management. Auditor should always avoid gathering any evidence through the management. Auditor should endeavor that the auditor should himself get the evidence directly himself and not involve management while gathering the evidence. Next topic is methods of obtaining audit evidence. What are the methods which you can employ to get the audit evidence? As I've already told you guys, you can hear, look at, or see some things to get an audit evidence, and secondly, you can have documentary evidences to have audit evidence. So these are the ways or the methods of obtaining audit evidence. Number 1 is inspection, that is examining. We can scrutinize what documents are available. We can inspect what documents are available to ensure that that transaction has actually happened. So inspection is one way. Second is observation. This is using your eyes, using your sight. You can see whether the process, you can witness whether the process or procedure is being performed properly. Third is inquiry and confirmation, guys. Inquiry and confirmation means you can ask the management of the company for their confirmation on a particular thing, like debit balance of their cash bank account. So if there's a bank account and there's a balance kept in the bank account, then you can get an inquiry or a confirmation on that particular bank account. Then computation. This is an important aspect of any audit, guys. Sometimes auditors recompute the entire mathematics themselves. So for example, depreciation. To ensure that depreciation is computed properly, the auditor will recompute the entire depreciation figure, and then he will be satisfied that yes, depreciation is correctly disclosed. Then last is analytical review. This is a specialized kind of method which is required, which is used by the auditor to obtain evidence. This, guys, include ratios and trends. Some past details are required for this particular step, and I'll give you an example. So for example, the last year's balance sheet and current year's balance sheet will be kept side by side in an Excel sheet. Then the figures will be deducted and the percentage increase or decrease will be analyzed. This way, the auditor will be able to understand that if there is an increase or decrease in a particular figure, then what is the reason for it. So for example, if there is a 20% growth in the entire organization, then all the figures, be it sales, be it expenses, should increase by 20%. If there's an abnormally high increase of say 40% in marketing expenses, then the auditor can ask the management the reason for the same. So this is known as analytical review of a particular aspect of the financial statement. So guys, next topic which we are going to start is compliance procedures and substantive procedures. So basically the procedures which are followed by the auditor, the process, it is divided into two parts. First part is known as compliance procedure or test checking, and second part is known as substantive procedure. To explain the difference between these two things, these are the two methods of obtaining audit evidence. So auditors use this two things to collect audit evidence. So to explain these two things, I'll give you a very simple example, guys. So there's a boy in my class. He belongs to CMA final group 4. He is giving group 4 examination in December 2019, and this boy is really a notorious one and has got a girlfriend. That girlfriend fears, or that girlfriend is not sure whether the boy visits our coaching classes or goes somewhere else, taking it as a excuse of going to the coaching classes. Now the girlfriend of the boy can employ two procedures. Procedure number 1, the girlfriend can call up the institute reception and ask whether the boy is in the institute or not. This is procedure number 1. And the boy can also have a tab, the girl can also have a tab on the timings when boy leaves his home and when he gets back his home. So these are the test points which the girl can test to ensure that the boy is reaching the organization, the coaching institute, well on time, and he is actually going to the coaching institute. Process number 2 can be, now this boy is very smart. He has bribed the receptionist of the coaching institute to tell her that if some girl calls and asks whether I am in coaching institute or not, then you have to say that yes, I am in the coaching institute. So this boy is very smart. He can play around with the controls which are employed in a particular organization, and this smart boy is the management of the company who's trying to befool the girl. Girl is the auditor of the company. So this boy can very well play around with the control testing bit, the test check which is employed by the girl, and girl is maybe she is a bit naive that she is not able to understand this particular aspect of the boy. So the second procedure which girl can employ to be 100% sure about the transaction is that girl can hire a detective and that detective can be with the boy all the time, follow him wherever he goes, and gives accurate picture to the girl. Now guys, process number 1 which was followed is known as compliance procedure or test checking, where we do not see or audit the entire transaction. We just look at the checkpoints, the important points through which the transaction goes through. We only check those points. This is known as test checking or compliance procedures. Substantive procedure are those procedures which test the organization or which test the entire transaction properly and do not leave any aspect of the transaction. So this is the difference between compliance procedure and substantive procedure. Now you would appreciate one thing, guys. Substantive procedures are a little difficult to follow. Why? Because substantive procedure will take a lot of time and effort, and substantive procedure will also be very expensive because hiring a detective is very expensive. Similarly, in an audit of a business organization, if I want to apply substantive procedure, I will not apply it to all the account heads. I will apply it to very highly risky account heads, very important account heads. For the other account heads, I can simply go with the compliance procedures or the test of controls. So these are the two procedures which are employed by any auditor. Substantive procedure involves 100% checking of the transaction, and test check or compliance procedure involves only controls testing. So if controls are working fine, then I assume that the transaction will also be working fine. So this is the difference between substantive procedure and control testing. And this is the difference which is given the tabular form. It involves checking of only control points of the transaction. It involves checking the complete transaction. It is very first step. It starts where control testing ends. It is less time taking and less costly. It is more time taking, more costly. Commonly used for relatively less material account heads. It is used for less difficult account heads. It is used for highly critical account heads. There is one type of compliance procedure, control testing. There are two types of substantive procedure, test of details and analytical procedures. Guys, you just need to remember the names of types of procedures. You need not go into the details of these procedures. So yes, this was the difference between substantive procedure and compliance procedures or test checking. So guys, there are certain questions which are given as practice questions to all of you, which contains past examination questions also, and it is really important for you to read through all these questions. Somewhere I have also put in certain answers to make you well aware of the kind of answers which are expected by the institute. So yes, this marks end of our chapter number 2 of the audit marathon, part number 2 as well. Guys, do revise your audit at least 3 times before attempting in the examination, because audit is all about revision. If you revise it thrice or 4 times, then it will be really good for you, and you can hear these marathons while traveling, while going to somewhere, while coming back from somewhere. You can just quickly revise your entire audit through these audit marathons. And if you like these marathons, please press the like button so that I can be definitely, it will be motivating for me also to produce the next marathons. And I will definitely be producing the next marathons, and will be continuing with this marathon classes for the next chapters as well. So that's all for this chapter, and that's all for today. We'll meet in our next marathon video. Till that time, all the very best and happy studying. For latest updates and information on entire CMA profession, just subscribe to our channel and don't forget to press the bell icon to get notification on the latest videos which are being uploaded on the channel. For products related to paper number 19, paper number 20 for final students and paper number 12 for intermediate students, log on to www.agrawallawhouse.com. It contains the compilation of handwritten notes, books, reference materials and video lectures of these 3 subjects. If you have any further query or you want to speak to me personally for any kind of counseling, you can call me at the number given on the screen.